The argument would be that the market is expecting a pause, in effect.
And if it doesn't get one?
It's going to be ugly.
I can't have you here on stage with this great crowd of supporters without asking you about the trade war. You just went out on X a couple of days ago saying we need to pause the US-China trade war. Tell me exactly why you think that's a good idea.
My theory is as follows. 145% tariffs are basically a complete shutdown in trade with China. The repercussions for U.S. businesses, beginning with small U.S. businesses that source any meaningful amount of their product from China, it is pretty much decimation. They will, they cannot mark up, think the toy retailer in Austin, buying goods for Christmas. They're done. And when you go to war, it's very important, and trade war or other war, that economically you are as powerful as you can possibly be. And this tariff actually threatens us economically and the uncertainty. And by the way, it's not just small businesses. It's medium-sized businesses, it's large businesses. It's a bit like COVID, except the Hilton survived COVID, but the guy who owned one hotel, absent the government stepping in and lending money, he was toast. And so my argument is Trump has made his point that the U.S. is going to be fierce about negotiating for various strategic and economic and other reasons. And he's accomplished that already. But what's interesting is if you take the tariffs down from 145% to 20% against China, then the ball is now the ball's in China's court. And what I mean by that is every CEO of every business that sources in China right now is desperately trying to find another alternative, move their supply chains. That's not going to change when you take tariffs from 145 to 20. They're going to be that much more motivated to do so. The longer that China takes to negotiate make a deal with the president, the higher the probability that every business leaves China on a fairly permanent kind of basis. So I think it actually, by lowering the tariffs, it makes time our friend in the negotiation and time China's enemy. Whereas right now, I think it's really the enemy of both. What's sort of fascinating about this is when we take them down, it becomes, now we have the staying power because the 10 or 20% tariff is manageable for nearly all businesses.
The economic relationship between the U.S. and China has been, let's just say, complicated for the better part of a century now. In 1949, the U.S. cut off nearly all trade with China. The two countries were geopolitical enemies. For decades, they had no diplomatic relations and virtually no economic ties. After China began economic reforms in the late 1970s, U.S. companies started trading with China. It was small at first, mostly grain, machinery, and textiles, but the idea was simple. The U.S. wanted access to a huge new market, and China wanted capital and technology. Take a look at this visual here. The black line represents U.S. imports from China, the total value of goods Americans buy. The blue line shows U.S. exports to China, goods the U.S. sells to Chinese buyers. The gray shaded area is the trade deficit between the two countries. As you can see, during the 1980s and 1990s, trade between the U.S. and China was fairly balanced. But in 2001, everything changed. China joined the World Trade Organization. That moment marked a turning point. With access to global markets, China became the world's factory, and U.S. companies moved quickly to outsource manufacturing in search of lower costs. Imports from China surged, and the U.S. trade deficit ballooned. The rise in the U.S. trade deficit with China brought both benefits and drawbacks. On the plus side, American consumers gained access to a massive wave of low-cost goods, from electronics to clothing, which helped keep inflation low and raised living standards. U.S. companies also profited by outsourcing production, lowering costs, and boosting margins. But there were serious downsides too. Millions of manufacturing jobs were lost, especially in the Midwest, as factories closed or moved overseas. Entire communities were hollowed out, fueling economic anxiety and political backlash. This chart tells a powerful story. From the 1970s to the 1990s, U.S. manufacturing employment remained steady, a backbone of the middle class. But starting around 2000, that stability disappeared. Millions of jobs vanished almost overnight as companies began moving production to lower-cost countries. It was one of the most dramatic shifts in the modern U.S. economy. At the same time, the growing deficit meant the U.S. became increasingly reliant on China, not just for goods, but also for capital, as China used its trade surplus to buy up U.S. debt. In short, the deficit gave Americans cheaper products, but at the cost of domestic industrial strength and long-term economic balance. This is where tariffs enter the picture. Tariffs are one of the oldest tools in the economic playbook to address trade imbalances. When a country like the US runs a large trade deficit, meaning it imports far more than it exports, tariffs can be used to make foreign goods more expensive. The goal is to reduce imports, encourage people to buy domestic products instead, and ideally shrink the trade gap. In theory, this gives local industries a chance to grow and compete, but it doesn't always work so cleanly in practice. Listen to Ackman explain.
There are some economists, I'm thinking of the guy at Apollo, who really think a recession is now inevitable, whatever happens, because there's so much trade policy uncertainty that even if the president takes your advice and there's a pause or they lower the tariffs on China, it's still going to happen because the shock has been administered. How do you think about that chain reaction? When do we get from financial markets being unhappy or confidence indicators moving to the real economy feeling it? How do you think about that chain reaction?
So this business fundamentally is a confidence game, right? If you're not confident in the future, every decision a CEO makes is based on a prediction about the future. The extent the future becomes uncertain, what do people do is they pause. And they don't hire the marginal person. They don't put the shovel in the ground to build the next factory. They just, the great wait is what they do. And I think, that is actually going on. And I think the second quarter is going to be meaningfully weaker than Q1. Q1 had the benefit of a lot of front-loaded purchases as people tried to get ahead of the tariffs, whether that's cars or, flat screen, sort of TVs. Q2, the pause is sort of underway. I think the only thing mitigating it is that the markets are stable. Actually, markets are up, a bit since Trump. But that will fade very quickly as if we start getting closer to the 90-day pause without some meaningfully positive announcements with respect to the reciprocal tariffs. And I also think, with the China situation resolved, now China's already showing a little leg here, right? They've eliminated the tariffs on about $40 billion worth of trade. There's been some positive kind of language. The Chinese sent a delegation very secretly to meet with Treasury Bessent, and they were caught by Korean media on the way into the Treasury building. So I think all of these things have caused the expectation to be we're going to pause and we're going to make progress. I think if we don't, then we're going to be back in the soup, which is where we were before.
While tariffs often make headlines and get attention for raising prices, the bigger economic risk is the uncertainty they create. When the U.S. imposes tariffs on imports, it doesn't just affect the cost of goods. It disrupts the global supply chain and creates a wave of economic uncertainty. Suddenly, businesses don't know what to expect. Will tariffs increase again? Will they expand to more products? Will other countries retaliate? That kind of unpredictability makes it harder for companies to plan ahead. As Ackman mentioned in that clip, when companies get nervous about the future, they pause. While pausing may sound harmless, it can send shockwaves through the economy. Think of it like trying to build a house during a storm. One minute the skies are clear, and the next winds are howling and rain is pouring. Would you keep pouring the foundation? Probably not. You'd pause, wait it out, and reassess. That's what businesses do when tariff policies become uncertain. They delay hiring, investment, and growth plans until the economic weather clears. Imagine you're running a business that depends on imported materials. If tariffs suddenly make your costs jump by 10 or 25%, you're left scrambling. Do you raise prices? Do you find a new supplier? Do you cancel a planned expansion? For many firms, the answer is to slow down and wait, which in turn slows the entire economy. Consumers feel it too. Higher prices on everyday goods, job insecurity, and rising headlines about trade wars make people more cautious with spending. That means fewer cars bought, fewer home upgrades, and fewer nights out, all of which softens demand across the economy. When both businesses and consumers pull back at the same time, growth slows. Investment dries up, demand falls, and the economy starts to lose momentum. If that continues, it can lead to a recession, falling GDP, rising unemployment, and shrinking confidence. So while tariffs may seem like a tool to protect domestic industries, they can also set off a chain reaction. More uncertainty leads to less investment. Less investment leads to weaker demand. And weaker demand leads to an economic downturn. Like a sudden storm, they can cloud the outlook, and if they linger too long, they can wash away growth entirely. Just to be clear, Bill Ackman doesn't oppose the idea of tariffs. What he's warning against is the spread and scale at which they're applied. When tariffs are rolled out too aggressively, they can create waves of uncertainty that hurt business confidence. By taking a more gradual, strategic approach, the U.S. can reduce that risk and negotiate from a much stronger position. This leads to a very important question. With all this economic uncertainty, just how should we be investing? Listen to Ackman explain.
We try to own businesses where no matter what's going on in the world, what we call extrinsic factors we can't control, whether those are commodity prices or tariffs, or a pandemic, interest rate volatility, don't have a material effect on the business. So we look for what we call durable growth companies. And these are the kind of businesses we're going to try to find for Howard Hughes. They're very much insulated from things macro. Obviously, they do better. Every business does better in a positive growth environment, does worse in a weakening growth environment. But our companies today, other than Nike, I would say, have really not been directly affected by tariffs, although market prices move up and down based on uncertainty.
Does that not bother you, though?
No, it doesn't bother me.
Bill Ackman has a simple filter when he looks for great investments. He wants businesses that aren't heavily affected by unpredictable outside forces, what he calls extrinsic factors. Things like tariffs, interest rate swings, or geopolitical headlines. If those kinds of shocks don't actually hurt the business long term, then short-term price drops can be a buying opportunity. Take Hilton Hotels, one of Ackman's core holdings. Hilton Hotels is a global hotel company that makes money by managing and franchising well-known hotel brands, without owning most of the properties. When people couldn't travel much in 2020, Hilton stock got crushed. Hotels emptied out, and investors panicked. But Ackman didn't sell the position he had in Hilton. In fact, he actually bought more. Why? Because the problem was external and temporary, not fundamental. He believed people would travel again, business trips would return, and Hilton, an asset-light, high-margin franchise model, would bounce back stronger than ever. And sure enough, it did. Hilton stock recovered, generating hundreds of millions of dollars in profits for Ackman. Ackman's view is that if a business is structurally sound, with strong branding, pricing power, and recurring revenue, then external shocks can actually create mispriced opportunities. Tariffs or economic slowdowns might spook the market, but they don't destroy the value of a business like Hilton. That's the key. Understand the difference between noise and real damage, and use that difference to your advantage. If you want to invest like Bill Ackman, spotting great businesses and using market fear to your advantage, you need a disciplined investment framework. But that doesn't mean you need to spend every weekend buried in financial statements. That's why we created Investor Center Research, a monthly stock research service built around the timeless strategies used by investors like Buffett and Ackman. Every month, you'll get one high-quality, mispriced stock idea from our team of professional investors with backgrounds in Wall Street, private equity, and venture capital. We'll walk you through how we value it, the price we're willing to pay, and why it fits the long-term investor's playbook. No hype, just real research and a focus on long-term, quality investing. We're launching soon, and we're only opening up 250 founding member spots. These early members will lock in our lowest ever price for life and get early access to the platform. Click the link in the description to join the waitlist now. And if you're watching after we've launched, that same link will take you straight to the product so you can dive right in. Plus, when you sign up, you'll get our free Warren Buffett investment checklist. 25 timeless questions Buffett uses to evaluate any stock. So hit the link, grab the checklist, and start investing with clarity and confidence, just like the best do. I will see you over there.